This video is part 3 of a 3-part series on emergency funds and sinking funds. And in this video, my focus is going to be on how big your emergency fund should be. In this video, I am going to recap parts 1 and 2. I'm going to talk about your emergency fund and sinking fund size, and then I'm going to talk about how I manage my own liquidity. Specifically, I'm going to be discussing my relationship with cash, why I begin separating my sinking fund from my emergency fund, and then I'm going to talk about where I keep my cash. But before we do that, here's a little bit about me. Hi, welcome to my channel, and I'm glad to have you here. Here's a little bit about my family. Our household consists of myself, my husband, and my toddler. My mom also lives with us, but she's not included in our finances. My husband and I both went to graduate school, but we no longer have student loan debt, fortunately. I work in banking and he works in aviation. I handle all of the family's finances, and I love my role as the self-appointed CFO. I love talking about all things money, making money, saving money, investing money, and optimizing my portfolio and my finances in general. I look forward to taking you on a wealth building journey with us. I hope you enjoyed the videos and the channel as a whole, and I look forward to getting to know you. I am very open, so feel free to send me messages at any time or starting conversations in the comment section below. Like I mentioned, this is the final part of a 3-part video series on sinking fund and emergency funds. All 3 should be watched in sequence. If you haven't seen parts 1 and 2, stop here and go watch. I will link them both directly in the video and in the comment section below. In part 1, it was all about the basics. I discussed emergency funds, sinking funds, different types of financial shocks, all in an effort to lay the groundwork for the rest of the videos. Part 2 was dedicated to identifying the different sources of funds that we have access to in case of financial shocks. I ranked their liquidity by measuring their speed, their cost, and their ease of access. When it comes to emergency fund size, is bigger always better? Let's discuss. The traditional recommendation used to be 3 months. Following the great financial crisis in the mid to late 2000s, it became 6 months. Both of these recommendations were based on the average time it took to find work during a recession. But these are just rules of thumb. Personal finance is personal, and you will have to adapt to your own needs. For example, do you live in a dual income household? Do you have a high demand skill? Are you in a recession-proof industry? Do you have multiple sources of income? Do you rent or do you own? If you are in a dual income household and you work in different industries, it is unlikely, not impossible, but unlikely that you will both lose your job at the same time and be out of work for the exact same amount of time. If you have a very high demand skill, you might get laid off anyway, but you might bounce much quicker than somebody else. If you are in a recession-proof industry, you are not likely to lose your job because people are going to need their hearts taken care of whether or not the economy is bad. If you rent versus if you own. If you rent, you might break your lease by paying a penalty and then moving back in with your parents. If you own, that's not really an option. Certainly you can stop paying your mortgage, but the penalty is not going to be that small. If you are enjoying this video so far, don't forget to hit the like button so the algorithm knows that it's good, and of course subscribe for more content. If you think any of the information that I provide here might be helpful to somebody else, be sure to share it with them. When it comes to the size of your emergency fund, you have to remember that cash has a cost, and the cost consists of 2 parts. First, the opportunity cost of missing out on investment growth, and second, it is the cost of losing your purchasing power through inflation. Therefore, more cash does not necessarily translate to a better outcome, especially over a long-term horizon. When you are building an emergency fund, your goal isn't to have the most cash, but your goal is to have the right amount of cash based on reasonable expectations of different types of financial shocks. Speaking of cash, I'm going to give you a little bit of context regarding my relationship with cash. My relationship with cash was initially shaped by my desire for safety and a lot of inexperience when it comes to investing. I was fresh out of college. I didn't grow up with money. I had frugal parents who knew to live below their means and to save the difference, but they were not financially savvy enough to know about investing. I grew up as a saver, but I didn't didn't trust the markets, not because of conspiracy theories, but because I was raised to know that you do not mess with what you do not understand. As my account balances grew, as I continued to work and continued to make a little bit of money, I realized that if I kept saving, I could buy a starter home. Of course, I made sure to get the full match on my 401k because that was being managed by somebody else. I didn't think much of it, but I did not touch a Roth IRA because I wanted the cash for the down payment, and I figured since I was the one managing that money, unlike the 401k, I was bound to mess it up anyway. I can't mess up cash. I grew up with cash. I knew how to handle cash. Not the same for stocks and bonds. And I did eventually buy that starter home. But once I did buy it, I realized that I wanted more cash for safety because I had to protect my investment. Over time, the amount that I found acceptable to have in cash varied. First, I needed the 20% down payment for my starter home because I wanted to avoid PMI by any means necessary. But then once I did use that 20% down payment, I was constantly moving the goalpost about how much I needed. The amount just kept going up and up and up. And that was mostly driven by the fact that I do have anxiety about money. I do have some anxieties about my finances, and hoarding money is part of my coping mechanism. I actually address some of that in my mid-year review video. I will link it in the video and in the description box below if you want to take a moment and check that out. Subsequently, I started venturing into investing outside of my 401k, and I began picking individual stocks with mixed results. I bought Nvidia, I bought Apple, Ford, but I also picked a ton of penny stocks that went down the crapper. That was until I learned that index funds were available outside of 401ks, and then I started investing in index funds. Finally, after going through all of these ups and downs, I developed a method that gives me plenty of liquidity, not at the cost of growth, and I manage it in a way to mitigate the risk of inflation. Why exactly did I begin separating my emergency fund from my sinking fund? If you watched Part 1 and Part 2 of this video series, you already know that I stated that not every financial shock is an unplanned emergency. I discussed it in Part 1 when I talked about the difference between an emergency fund and a sinking fund, and when I covered the different types of financial shocks. I understand that not everybody has cash set aside, but if you're watching this video, it means that you either have the cash set aside or you're planning to have the cash set aside, because the personal finance community definitely has a lot of selection bias for people who are either doing very well or people who want to do well and are working towards it. For those of you who are good savers, I find that your emergency funds tend to be okay, but it is your sinking fund that is not doing so well. And that's not an indictment on you. I wasn't that different. The reason why your sinking fund isn't great is because it's a bit of a blind spot. You're not actively ignoring it, you're just not thinking about it. Let's talk about where I keep my sinking fund. The first place is I-bonds. I started moving cash last year. If you want to know more about I-bonds and my emergency fund strategy, check out the 2 videos that I made on the topic. I will be linking them in the description box below. The next place is my Bank of America savings account. I've used Bank of America for a long time, since I was in high school. I even have my main brokerage with their related company, Merrill Edge. It is my main bank and it has a physical presence. I use it as my sinking fund. Transfers from one account to the next are at the same bank, since that is where I have my checking account. I can get my money in minutes if I need to move my cash, either by writing a check or by going in person to make a withdrawal. The third place that I keep my money is my American Express high yield savings account. It has a relatively competitive interest rate, and I know from my experience having their Gold Rewards credit card that they have good customer service. However, it is an outside online bank, so moving money can take 1 to 3 business days. I don't have a branch that I can go to. I don't have a checking account with them. It's gonna take some time for me to move my money. So I don't keep my sinking fund there, I keep my emergency fund there. And then I have a small local credit union that has a balance of less than $2,000, just for the sake of keeping it open in case Bank of America does something egregious that I find unacceptable and I need to move my money. These days, because of all the customer identification program requirements and all of the information that banks have to ask you, opening a bank account can be a bit of a hassle. So I like to have a place that is already available to me. Also, if there's an issue with online accounts, or if I want to take advantage of certain perks that they are offering that are only for existing customers. I already have an account there. I'm already an existing customer. It's much easier for me because I'm not scrambling at the last minute to open an account, providing all of this information since I'm already on file. You know where I keep my cash? Now let's talk about what I keep in my cash accounts or cash equivalent accounts. For my emergency fund, my combined balance consists of two types of funds. The first type is based on unplanned expense shocks. That includes all of my deductibles. That would be first the insurance on the primary residence, the insurance on the first rental property, the insurance on the second rental property, the insurance on the first vehicle, the insurance on the second vehicle, and then the health insurance, the medical insurance for all of us for the year. I have all of the deductibles covered. That is included in that balance. The second category is based on unplanned income shocks. It's a little bit more of a calculation, not quite straightforward. I will explain. I hope you follow, but it will certainly make a lot more sense if you watched parts 1 and 2. The first thing that I do is I calculate 9 months of expenses. Then I adjust for unemployment insurance for both of us. I adjust for vacation time payout for both of us. My husband has a balance of 8 weeks, which is the equivalent of 4 paychecks. I have a balance of 6 weeks, which is the equivalent of 3 paychecks. And for those, I check annually and I adjust them as needed. I do not make any allocations for planned items, whether they are income or expense items. If they are planned, they are not included here because they would be included in the sinking fund category. If this calculation of an unplanned income shock seems too generous to you, here are some things to consider. We are a dual income household. We receive rental income from 3 different sources. I live in a state with generous unemployment insurance benefits. Finally, I am only including the cash and the I-1 portion of all of our liquid assets. In order for me to deplete everything, I would have to be in a situation where we both lose our jobs, none of the 3 rental properties are paying, and we have both depleted our unemployment insurance benefits, which, by the way, in my state go for 26 weeks with a cap of $900 a week. Could it happen? Sure. Is it likely? Probably not. And I want you to hold on to this as we continue so I can expand on likelihood more and how we manage the different expectations. Now, when it comes to sinking funds, I am adding money to a fund for the replacement of the second vehicle. The second vehicle is nowhere near needing to be replaced. It is only 6 years old. It has relatively low miles. I have a long time to save for this car. In addition to that, for my primary residence, I have a sinking fund for that as well. And that includes major repairs like the roof, the boiler, the water heater, the air conditioning, and the different appliances that we have in the house. For rental property number 1, I also scheduled some major repairs. That includes the roof, the water heater, the heating system, and the appliances. Rental property number 2 is actually in a condo. So instead of saving for a ton of capital expenses, I have saved for the appliances and potential assessments that could be levied for those capital expenses that are going to be spread around among all of the different owners through the homeowners association. We talked about my emergency fund and my sinking fund. Now, what is the worst that can happen regarding the emergency fund? It's not impossible because I've considered it. Both of us would need to be out of work the entire time at the same time. Remember, we don't work in the same industry, let alone the same employer. We would also have to have no paying tenants on all 3 rentals. We would have to deplete our unemployment insurance over the course of 26 weeks. If all of those things happen all at the same time, I would absolutely deplete my cash. But I have options beyond cash. I can tap into some of my sinking fund. Part of my sinking fund fund includes money to replace a dishwasher. A water heater is not a luxury, but a dishwasher kind of is. If things got that bad, I would probably take out the dishwasher money. That's just an example. Then, if I needed to, I would possibly consider maybe touching some of my Roth IRA contributions only, because I'm in my 30s. I wouldn't qualify to touch anything else without penalties. And then again, if I still struggle, I have a taxable brokerage account where I would consider perhaps cashing out some equities that are more than a year old, where I would ultimately be taxed on my gains, but I would be taxed at the long-term capital gains tax rate. So cash is not the floor. Cash is there to purposely support the most likely scenarios. Once you start having options beyond cash, then you can reduce your cash position. I mean, I just listed 3 options. What's a 4th one? Would I start hitting licks or scamming? I don't know. But the point is, I would have to get pretty desperate before every single asset and option completely disappeared. Just like I said that you shouldn't have too much cash, the point isn't to have an artificially low emergency fund either. The point is that my entire portfolio is my emergency fund, and cash is just a portion of that. The cash is set up to absorb the most likely and frequent scenarios for a reasonable time duration with an added buffer. Once the cash is depleted, I have other options that are less desirable, but they're still available. And they're certainly not less desirable than watching my child go hungry or becoming homeless. But the more unlikely scenarios, like losing 5 sources of income for more than 6 months, will cost me over time if I plan for them when I miss out on not investing because I'm waiting on something that might not happen for a very long time, if ever. Since we are still on this what if scenario, let me give you an illustration. Say there are 2 young ladies. They are very financially responsible. They make the exact same amount of money. There's definitely no question about the fact that they are going to have an emergency fund. They begin building an emergency fund in 2019, and they consider that there is a crazy possibility that they might total their car on the same day that they forget to pay to renew their insurance. Both estimate that the replacement cost of their vehicle would be $40,000. One of them is called Cautious Carla. She decides that in order to mitigate that, she's going to keep $40,000 in cash just to be safe. There's another one called Rational Rebecca. She realizes it is unlikely. It's not unlikely that she's going to get into an accident. It's not unlikely that she's going to total her car, but she thinks that it is unlikely that she will forget to pay her insurance and that it will happen the same day that she totals her car. Instead, she keeps $5,000 in cash because that is her deductible. And then she decided to invest the remaining $35,000. And then she said she will simply cash it out if she needs to buy a new car once she pays the deductible. If you are Cautious Carla, you have lost almost 14% of your purchasing power between 2019 and today in August of 2022 when I'm recording this video. That money is now worth less than $35,000. If you are Rational Rebecca, those $35,000 that you have invested, they are now worth $59,000. And the lowest balance that you would have had between the time that you invested in today, $36,000, when it crashed in March of 2020 due to COVID after a high of almost $46,000. Cautious Carla does better only during the dot-com crash, where Rational Rebecca ends with $32,000, and that is a short period of 3 years. In almost every scenario, especially if it is a longer period of time, Rational Rebecca does much better in the long term, including recessions. So that is it for this video series. I hope that you not only watched them in order, but that you enjoyed all of them equally and got something out of them. Given the timing of this video, my next one is likely to be a monthly budget update. If you haven't come across my videos before, I make videos about my personal finances where I discuss my budget, my financial goals, and I go into detail about how we spend, invest, and save money, among other things. If that kind of content interests you, make sure you subscribe and hit the notification bell so you can know when new videos come out. Before you go, let me know, what is your emergency fund earmarked for? Do you keep your emergency fund and your sinking fund separate? If you do, what is your sinking fund earmarked for? What advice do you have for me, or what questions do you have on my emergency fund or sinking funds? I will see you in the next one. I would like to continue sharing my thoughts on all things money with you. So I would appreciate it if you could help out the channel by liking this video and sharing it with anyone you think might benefit from it. If you want to see more content, be sure to subscribe and hit that notification bell so you can know when new videos come out. I'll see you in the next one.